Hello everyone, welcome back to my channel. Let's solve another NPV problem using MS Excel. So now I'm sharing my entire screen. Well, in this screen you can see I have already attached the question. So let's begin by understanding the questions. In the question, Karim Groups requires 140,000 units of a special types of spare part every year for the next 5 years. MS Hossain Enterprise plans to bid for this contract. To start production, the company must purchase property, plant, and equipment which worth 1.8 billion BDT. The equipment will be depreciated using this straight line method for over 5 years. And its estimated salvage value, which is 150,000. And the annual fixed cost is 265,000 per year, and the variable production cost is 8.5 per unit. The tax rate is 35%, and the required rate of return is 14%. And the project also requires an initial investment of 130,000 in net working capital. Now I will solve this problem following my structures method. First, we will calculate the project cash flows and then determine the net present value. So first, I will write down all the relevant information in the left side of the Excel sheet so that I can use all this information throughout my analysis. So let's write the particulars. First, we have the sales unit, which is 140,000. And then we have a project, here, which is 5 years. And then we have the initial outlay, which is 1.8 million. And then we have a depreciation. We can easily find out the depreciation by the purchase initial outlay divided by the project years. So here is our annual depreciation. We have a salvage value, which is 150,000. And then we have a fixed cost, which is 265,000. We have a production cost per unit, or we can just simply say variable cost per unit, which is 8.5 taka. And then we have net working capital, which is 130,000. We have a tax rate, which is 35%. And we have a required rate of return or the discount rate, which is 14%. So this is our supporting information. We're going to use this throughout our analysis. So let's write our project cash flows. Now the particulars, starting from year 0 to year 5. First, we have the sales unit, which is cell referencing is very important. And then we have a cost per unit of the variable cost, which is again using a log here. Our total production cost would be, remember, we are just calculating the cost for the project. So production cost would be sales unit into cost per unit. This is our cost unit per year. And then we will just simply write our fixed cost for each year, which was fixed for each year, again using a cell referencing. Now we will calculate the total cost. So our total cost would be production cost plus fixed cost. So this is our total cost. Now we will adjust our cash flows. Investment in net working capital, which was held in year one. So this is our recovery of net working capital. Well, it's not mentioned in the question whether our net working capital was recovered or not. So we are just assuming that our net working capital was recovered in year five. Since we are calculating our cost and the net working capital was recovered in the year five, so recovery cost is our cash inflow. So we are using a minus before it because it reduces the cost amount since we are calculating the cost. So here now, now initial outlay, which was in year one. Well, it was recovered as the salvage value in year five. So we will use a minus before the amount because it is our cash inflows. Now we will find out our March net outflow. For the formula, and the formula is equals to sum of so this is our March net outflow. Now we will calculate the NPV, and the formula is NPV, required rate of return, year one to year five cash flows plus the March outflows. So this is our NPV. This is the answer. So let's just give a touch up in the Excel. A soft pink color, soft baby pink. I think this one is nice. Uh, okay. Thick border. So well, this is it from my side today. Thank you for watching.